You know, 2025, a lot of people thought that was a tricky investment year to navigate. You recently wrote a very interesting article that you put on your website, genville.ch. I'm going to put a link to that article in the comments below. And you talk about the changes you're making to your portfolio in anticipation of 2026. So let's go through that. It's a good time to do it. Let's start off with a top-down, so a macro view, and then go into the individual sectors underlying, if we may. So starting off with the macro view, how is 2026 shaping up?
I think that the first thing that people need to have in mind is the fact that despite the fact that there is a lot of caution towards Europe, you have seen early green shoots that are telling you that the economic activity in Europe is rebounding a little bit. And I think that this is something that is quite important with regard to different elements. Also, I think that the key factor in the very short term is, and it's a big question, and we have our answer, maybe we are wrong, but I think that what we are seeing is a slowdown in economic activity in the US for the time being, but there should be some reacceleration in the spring. And I believe that is connected to the fact that you will have the fiscal expansion coming into life. You will have monetary policy easing in the coming months. And I think that we have more stability on the tariff side. So those elements should support a reacceleration. And in China, I think that there is room for the Bank of China to lower interest rates. I think that lately they have decided to put some program, some plan in order to support the real estate. And I believe that they are going to do something when it comes to consumption, because we all know that there is a disequilibrium in terms of growth in China, with investment and export being strong and consumer being under pressure. So I think that all in all, this is 2026 should be a satisfactory in terms of economic activity.
Okay, well, let's look at equities first of all then. The equities earnings have been impressive. Is that going to continue into next year?
Very interesting question. I think that you have conditions for that to continue, because when you look at the earnings season in the US, we have different factors which are very interesting. The fact that sales are growing, and not only growing into the AI segment, you see that growth is extending to different sectors, cyclicals or other sectors. The second element is that margin in the US are very high in US companies, and it is expanding again. It was slowing down a little bit, but it's expanding again. I think that with the economic scenario I mentioned, you have all the conditions for the earning per share to deliver. And for the time being, the consensus is expecting above 10% EPS growth around the world, with the US leading by 14%. And I think that those numbers are not completely realistic when it comes to the economic activity that you see in the US. So I am positive in terms of earnings, yes.
Within the equities sector itself, what are we going to do about the age-old argument, recent argument between AI and the old economy?
I think that you should diversify out of AI and get into the other sectors. As I mentioned earlier, you have signs that you have sales growing again in those segments. So it means that demand is there. And I think that one of the wise moves to do for 2026 is not to depend too much on AI stocks, because you can see that you have some doubts emerging when it comes to the ability of these sectors to really dominate over time. You have a lot of discussion about, is there a bubble in the AI segment? We have some news lately that are telling us that you have some fight between company and fight, quote unquote. It means that each one is trying to create the ecosystem that is going to be the winner. And we all know that if there is a winner, there is a loser. You should look at different sectors. You should look at cyclical stocks, which to my point of view are interesting. We have recently increased our exposure to raw materials in general. And with that, I consider that construction is part of the raw material. I think that energy, electrification remain a very interesting theme for next year. I believe that the need for energy is not going to disappear from one day to the other. And you also need to consider diversification into defensive stocks. Healthcare are recovering quite well over the course of the last 3 months, and I think that it could continue.
Do you think the recent news from Google that they are coming into the market as a competitor to NVIDIA, Do you see that as good news or bad news?
It's good news in a way. It's good news at the end of the day because it's going to support competition. And I think that this is what we need because we need innovation, but we need to have innovation that is not going to become monopolistic. And I think this is a good news. The fact that Google is coming with a chip that is going to be used by Meta, for example, in the AI sphere, does not mean that those two chips, NVIDIA and the one by Google, are exactly the same. They are not the same exactly, but they tend to have different elements that are very interesting. So I think that this is very good that you have some competition emerging. We need to observe that very, very carefully because, as I said earlier, you have a huge risk. There is a winner if somebody is really going to be able, through those developments, to really change, modify the environment and take a lead in the ecosystem. This is something that you need to go along with and not to escape.
The US dollar caught some people out. It made life very difficult for some people, especially in Europe, trying to match their performance with those in the US. What's your view on the dollar for 2026?
When you look at the dollar in 2025, what was very interesting is the first half of the year was one of the worst periods for the US dollar since 1973. This is something that was quite significant with more than 10% fall of the US dollar. Since the end of June, we went through a stabilization that is still going underway because of the fact that there were some doubts about the Federal Reserve. Was it going to lower interest rate or not, and etc. I think that they are going to lower interest rates. First cut in December. They are going to continue in the first 3 months of 2026. It's going to weigh on the US dollar. And I think that the US dollar is going to go above 120. Our target is between 122 and 125 in the first half of 2026. I must add that there is something that people need to be very vigilant about is what is going to happen with the Fed, because we all know that Mr. Powell is going to leave, but don't forget that you have other members that need to be refilled, and because they left and potentially they could leave because of a possible scandal with Mrs. Cook. And so the majority of the vote or the majority of the member could move towards Donald Trump will of easier monetary policy in 2026. So to my point of view, the conditions are there for a weaker dollar, at least in the first half of 2026.
And which of the currencies is the big winner in that amongst the reserve currencies?
I think among the reserve currencies are very few if you think about it. Real reserve currency, you have the euro, you have the US dollar. To a smaller extent, you have the British pound. But at the end of the day, I think in terms of reserve currency, I think that the euro is the winner. But there is another currency which I believe is going to remain very strong in 2026 is the Swiss franc. The Swiss franc is going to continue to appreciate both against the euro and the US dollar. And I think that if somebody wants to own a currency that is a quote unquote real currency, I would prefer the Swiss franc to the euro or the US dollar.
What's your feeling on bonds and credit?
We still remain quite overweight in credit. We believe that we have a lot of doubts about sovereign debt. This is the reason why in 2025 we had considered that credit should be the big chunk of our bond allocation. We remain with this view, but there is something that is a bit different from where we were a year ago. A year ago, we had a lot of high yield in our bond allocation. We have decided to reduce this allocation to high yield, and we have increased the investment grade segment. We believe that it's no more time to take too much risk on the bond side, and we don't want to accumulate risk on the equity side, the high yield side. So this is the reason why we are entering 2026 with less high yield in our portfolio. But nevertheless, we consider that credit remains the core position that you need to have in your portfolio. A second element in our allocation is that we have decided to be more tactical in the way we invest. This is the reason why we have selected a strategy that is much more total return and tactical oriented when it comes to bond market. And I think that this is the right strategy for 2026.
Gold has had a fantastic year in 2025. Is that going to continue into 2026?
The answer is yes. You know that I am, quote unquote, a fan of gold for quite a long period of time. We have discussed many times the fact that we were supportive about further appreciation of the US of the gold price. And I think it's not over. When you consider the fact that you have risks in the system, you shall never forget that we are not living in an environment where there is no risk. First point. Second point, I think that interest rates are going to come down in the US. It means that the opportunity cost of gold is going to fall further. I believe that the US are going to be tempted to bring the real interest rates of US dollar to the lowest possible level, which is also supportive for the gold price. At the end of the day, 4,500 is the minimum we could see in 2026. And then it's opened the door to 5,000 in the next 12 to 18 months.
What's your view on emerging markets for 2026?
We have increased our exposure to emerging market during 2025, and we stick with the idea that you need to be overweight emerging equities. We have two ways of investing in this area. First of all, we have a specific investment on Indian stocks that we tend to like. We believe that at the end of the day, there will be an agreement between the US and India on tariffs. And we believe that it's going to be supportive. When you look at the numbers, they are quite good. In India, inflation is coming down quite rapidly. Second, last week, you had the publication of the GDP in India, which was higher than expected. We believe that this is a market that was very loved for 12 months. And then suddenly, since the middle of this year, people did not like it so much, but we remain for the medium term on India. And then we have a general or global investment into emerging market equities in our allocation. And that comprises China, because you know that China is 30% of the index in the MSCI emerging markets. So it's a lot of India at the end of the day.
What's your target for equities? Let's talk about the S&P 500, for instance.
I think that for the S&P 500, considering that it's reasonable to expect 10 to 11% EPS growth, the market with the reacceleration I foresee is not going to experience a significant contraction of multiples. I think then you can have a target of 7,500 in 2026, which is 8 to 9% from where we are right now. And I think that this is something that is perfectly feasible for next year.
Do you see the 10-year US bond going down significantly in terms of yield?
It's a very, very good question. It's a tricky one because we all know that there is rumors that the Fed is going, and I think that they are going to do it. It's no more rumors. They announced that they want to quit quantitative tightening and they want to buy assets. So it is going to depend on the extent they are going to go back for purchasing assets. I think that it's going to stabilize, but it could go as low as 3.75, depending on economic condition, depending on the Fed target in the first quarter of next year. I believe that you could move between 375, 425, but I would not try to purchase sovereign debt in the US. I believe this is not the kind of assets that I want to hold in the portfolio. There is one asset that I like in terms of sovereign debt. It's the inflation-linked bond, because you know me, I still believe that inflation is not necessarily as well under control as many people consider. I believe that we could have some surprise on that side. So I believe that to have an investment, a diversification into inflation-linked bond is quite interesting for 2026.
You just mentioned quantitative tightening and quantitative easing. Do you think that if the US does go towards quantitative easing, which you are expecting, doesn't that put pressure on the Europeans to do the same thing in order to remain competitive?
Not necessarily. What is going to put some pressure on the ECB is the fact that the Fed is going to lower interest rates by 3 times, to my point of view. And then when the US dollars go to 122, if it goes to 122, then there will be a pressure on the ECB to consider that they should lower interest rates again. For me, the conditions are set for the ECB to maintain interest rates to the level they are today. But if the US dollar weakens too much, then there could be some pressure on the ECB board to consider that they need to lower interest rates in order to stop the depreciation of the US dollar.
François, I think that's all we got time for. Thank you very much indeed, and I look forward to speaking to you next week.
You have a good week. Bye-bye. Thank you.